Thanks for joining us this week for the Signature FD weekly audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer here at Signature FD. So last week was a relatively heavy week in terms of the volume of just impactful economic data that we got. Overall, the markets rebounded about 4% as that overall package of information really worked to quell any fears over lingering inflation or an impending economic recession. So, we're going to start this week with the inflation data. So, we got a read on producer prices first. Producer prices were up only 0.1% in July. Now, notably, core producer prices edged down slightly as service prices actually fell. Now, service prices fell because profit margins shrank. So, what's notable about that is that a cooling labor market has clearly hampered the ability of companies to fully pass on any input prices now. And that's really the lever that the Fed controls. They can slow domestic demand, leading to less core service inflation, which appears to now be the case, at least in the near term. Now, on the consumer price inflation side, both headline and core inflation picked up 0.2%. Now, when one strips out shelter, inflation looks to be running under 2% on a year over year basis now. So, Fed Chair Powell has noted that they like to watch non shelter inflation because they know that shelter has a considerable lag. And import prices at the end of the week were pretty benign as well, rising 0.1%. So, all of this inflation data is likely to provide the Fed with confidence that they can soon begin lowering their policy rate, more than likely beginning in September. Now, we think that any Fed cutting cycle would be slow and methodical outside of any sort of spike in unemployment. Now, on the economic growth side, we got an update on retail sales, which showed a bounce of 1% last month. That's the biggest monthly gain in retail sales since January of 2023. However, much of that snapback was in vehicle sales. Now, our friends at Ned Davis Research, they like to look at core discretionary retail sales. Now, that measure, that only ticked up 0.1% last week. So retail sales are really telling a similar story to the inflation picture. Consumption is easing in line with really tight monetary policy. Now, the economy is growing, but what our read on it is that it's growing at a slower rate than in prior quarters. Now, we also got some sentiment updates last week, and when I look at those, they really underscore the challenge in trying to use sentiment to gauge the true health of the economy. So small business sentiment jumped, and that was led by a surge in the expectations component. And the University of Michigan Consumer Sentiment Survey also showed an acceleration in future expectation. Now, the reason that these don't provide as much value as they once did is that they've really become very politically driven. So small business owners tend to skew Republican. And that survey was taken in a window when Donald Trump was firmly in the polling lead. And the Michigan Consumer Confidence Survey, that saw Democrat optimism rise strongly while Republican optimism fell, as that survey was taken when Harris started to tighten the race. So while sentiment was once a very useful leading economic indicator, it's really become much less useful in the past few presidential cycles. So what we've really had to do is to shift our focus to hard data rather than survey data. And chief among that data, we've been watching the labor market. Now, the employment report a few weeks ago, that rattled markets, but that seemed to be littered with weather disruptions. In the past 2 weeks, unemployment claims have eased, and that's helped to calm market jitters down. Now, this week is much more quiet from a data perspective. We're going to get some estimates of the purchasing manager surveys for August. And here on Monday, we got the leading economic indicators. Now, the leading economic indicators contracted, but they've spent much of this expansion in contractionary territory already. Again, that's because sentiment seems to be giving us a bad signal. And so's the yield curve, and both of those are components in the leading economic indicator calculation. Now, we are paying attention to housing. Housing starts have been slowing, and that's something that we do want to pay attention to that has historically had strong leading tendencies. But one of the positives on the housing side is we have seen that construction employment is still expanding, and that's a good sign for now. So, turning to market fundamentals, last week was the unofficial end to earnings season with Walmart's report. So, it looks like earnings are going to settle in at a low double digit rate when all is said and done here. Now, there's still some retailers to go through, especially as we progress through this week, but the earnings season is largely wrapped up. And regardless, we still see this as generally a bull market that's being driven by growth in corporate earnings. Now, that could change if the economy were to begin to contract, but for now, the uptrend remains intact. So join us next week to hear our take on the preliminary purchasing manager surveys and potentially any takeaways that we might have from Fed Chair Powell's speech at Jackson Hole on Friday. And as always, thank you for tuning in and have a great week ahead.